register available. So if you don't mind completing the attendance register, okay, so we know who is attended and so on. Remember, all these recordings are now available, where there was a problem last week, but it is back on again, so it is available now to be used. Okay, Mr. Lumbaro, you want to say something? No.
Yes, I am going to post the attendance register.
Oh, you're going to do it now. Okay, no problem. Okay, so let's start. So if we all go to your textbooks on page, I just want to mention where we actually, no, your study guides. So I'm just trying to get my thing in order here. Okay, I am. So page 91. So I'm going to change that to the screen now, so you can actually view what I'm watching. Okay, here we are. Page 91. So we move this down. Okay, so going back to the beginning, just to pinpoint what we have done. Okay, we done analysis information, risk and returns, scenarios of long-term, weight cost of capital. We also done advanced cost liability, cash budgeting. That's what we done last week. 2 weeks ago, we did mergers and acquisition, elementary of pricing, valuation, financing issues. Remember to use table A and table B when answering a cash budgeting question. It will be available to you in the exams. Okay. Today, we'll be doing cash management, which is a treasury function, as well as a currency interest rate risk. Okay, so if we all go to your study guides on page 91, I'm going to be sending you from here to your textbook, so we're going to jump from one page to another, okay, back and forth. But yeah, so I suggest you keep your finger on your pen, finger on your book. So when I tell you to please turn the page. Okay, this textbook is unlike the one I have in front of me. This one is actually page 86. Okay, so the attendance register is now available. You can complete it as well. Okay, so here is some of the ideas, the reasons, the functions of treasury function: a strategy, tactical, and operational decision. So strategy is obviously to prepare policies and consider the capital structure of the business and organization and how to use the funds in the business, a strategy of how to utilize the funds to make profit. Technical decisions is such as taking risk by management and decision hedging, using the monies to invest it into the business where you can make better, effective, more cash from that money. And one of the things they do ask is the hedging of currency interest rate, which is the next chapter, by the way. Operation and decision, such investments and surplus is what we're going to be utilizing, what we're going to do with them, the working capital of the business. Okay, so here they want you to go to chapter 9 and chapter 14 of the textbook, but as we go along, I will explain. So here we have a strategy of how we do the treasury function. I call number 1 here, setting up strategies and objective of the finance, okay, for the corporate finance, number 1. Following the managing liquidity and the working capital of the business. We're going to be talking about working capital today as well, okay. One is obviously finding out what the objective is of the business, and it's not just making profit. You have to take into consideration the long-term goals to take into in a business. If it was just to make profits, we would still be living in a traditional method of business. We will not be looking at all our stakeholders at hand, okay? Managing liquidity is the next one, how you manage it to make sure it remains positive, or it always, you utilize all the capacity available to continue making money, okay? We will talk about that later. Then moving forward to step number 3, I'm doing the clockwise scenario. I did setting up the strategies, managing liquidity. Number 3, identify the best source of finance by considering the fund policy, interest rate, security period, which the funds are required. So here we obviously have pinpointed before, debt is a good set of finance. Equity too. Although equity can become expensive and long-term, debt is not, but debt has its advantages and disadvantages. One of the major disadvantage is the fact is you got to pay that debt back, and that is a capital repayment, which takes strain in the business. So for that, you must maintain a good management of your working capital to able to pay the debt. Also take into consideration WACC into the picture, because here is where you decide what is your optimal point, what is your best effective percentage of equity you should have in the business, as well as debt. Managing currency and exposure of exchange regulations, that is later on in the same chapter. We're going to be talking about what do you do with the money, how you measure the money. Is it wise to take forward exchange rate, local transaction on spot? I am strongly in favor of FECs, forward exchange rate, especially if you are running or living in a country that there is a fluctuation in currency from regularly, like we're currently having in this country, our fluctuation of the rand versus the big currencies like the dollar, pound, and the yen are always never stable. It's always fluctuating, and it's not negative, not positively, but mostly negatively. COVID has brought it down quite dramatic. So imagine the scenario. As I told you from the very beginning, I'm an import and distributor, and one of the things that we do when we import, we pay in foreign currency. Last year, we were paying 19 to 20 rand to the dollar, where currently we are paying 14. There was a lot of speculations last year. People are saying, oh, is the dollar going to still increase? It's going to go up to 25, 30 rand to the dollar. And like everybody's scared, oh, is it viable to import? So with all of that speculation, it sometimes forces a person to take FECs and fix somebody to that. Luckily for us, we didn't do that last year. We thought after the big cloud of COVID is over, things are going to get better. And we see the improvement already. It's no longer 19, is now setting at 14, 15 to the euro and to the dollar, which is much better improvement. But then again, one should think about FECs. Okay. The next one is corporate financing, including raising share capital, project finance, and the dividend policies. Okay, there's more students coming on board. Please, Lavina, you have something to say? I need to put you on mute. Do you have a question to ask? No, okay. So I want you to take into consideration the circles, and this is what happens. You're setting up your strategy, you're managing your liquidity, you search for your sources, where your sources of income come from. Then, sorry, put this person on mute. Okay. Then you manage your currency if you are working on an import or export entity. Some of these functions are basically taken out if you're working with local currency only. And last one, corporate finance, including raising share capital, once again, equity and dividend payouts, okay, of the business. And basically you start over again. Okay. Here gives you some guidelines with regards to the risks that should be included in the following risks on treasury, and is identify the assess methodology. This refers to MAC3702. You're not going to be examined on it. Levels of risk that are acceptable required for mitigation action. Okay. Now take into consideration the higher the risk, the higher the return on equity, the QE. Okay. So take into consideration the higher the risk, the more is requested, more required by shareholders for the risk, and with that comes along a higher demand for your WACC. Okay, as KE increases, so does your WACC. Guidelines for risk responses, mitigation action plans, and reducing. So in this question, in this exam, you're not going to just be asking number crunching question. You need to provide explanation, guidelines, definitions, reasons, the discussion questions on why the risk, What causes that? So this is imperative. If you can remember our first lesson, and I told you to be very much involved with financial statements, start making stories, reading financial statements, but what is happening from one year to another, and creating a story behind it. Because from that develop questions and discussion questions, which you bring up to the paper when it asks of you. Just take into consideration when those discussion questions come up in exams, okay? You're not going to be marked negatively. What I do ask of you is to make sure those questions are right in point form, okay? Why? If you write in long paragraphs, it's very difficult or very unattractive for the marker to sit down and read 3 pages of discussion question where you can write 3 pages of point form questions and get marks for every single point. You're not going to be marked negatively. There's not going to be minus marks in it, as long as you stick to the text, obviously. Okay? Decisions to centralize treasury and function. Now, this has come up in the exam before, okay, where you make a decision whether you centralize your treasury or you should utilize it in each individual. What do they mean by that? I mean, we take, for example, Coca-Cola. Coca-Cola is all over the world, as we all know by now. For those who have traveled and for those who are here, I have probably seen in ads that it's also seen in movies that they have Coca-Cola in overseas as well. So Coca-Cola is so big that its own treasury is on each of those countries. Each of those countries control or have their own treasury. So is centralized function is in each department, in each function, in each country, there is one. There's advantages to it and there is disadvantages to it too. Okay. A company that has everything centralized that I can think of right now in Cape Town would probably be a company like ShopRite Checkers, the corporate stores, or the Checkers with the corporate stores, okay, where they control the funding, is completely centralized. They do all the funding from one head office, okay? Unlike Coca-Cola, there is different divisions. There is advantages and disadvantages. You need to be aware of those advantages and disadvantages. Yeah. Large multinational organization with subsidiaries and associates in various countries needs to be decided whether they should centralize the treasury function or not. Like I gave you the example of Coca-Cola, that is not centralized, which is brilliant. Well, there's advantages, as I said, and there's also disadvantages. Companies like ShopRite Checkers is not centralized yet. Maybe moving further, it will be. When treasury functions are centralized, it acts as a bank, ensuring that the cash available to the individual operating units, that excess cash is invested and related risks are managed appropriately. The Treasury Department requires a specialist skill to manage and assess the full range of available capital instruments, investments, methods to manage this effectively. It will be beneficial if the treasurer maintains a close relationship with the organization or bank as they acquire knowledge of the market and available capital instruments. Let's now investigate the advantages of centralizing versus the decentralizing treasury. Before we go into that, look what it says here. So if you are running a business and is centralized or non-centralized, the Treasury Department must have like direct hands-on with the bank and the business in itself that is managing, because the two of them are actually related. You can't, for example, you require something, and we will see now that on the functions, you require funds for buying stock, let's say, at a better rate or whatever. And now you request it from the main company. The main company, the centralized company, says, listen, in our country, we cannot transfer funds now. The currency is too low. Can you see where I'm coming from? So when it comes to a department or a decentralization treasury, that country on its own, like Coca-Cola, makes their own decision within its own country. Okay? So here are some of the advantages of centralizing treasury. One, a specialized expertise in financial marketing, taxation, transfer pricing, and concentrate decision about the hedging, currency risk are made in best interest of the organization, bearing in mind that any decision made are lawful, especially to foreign exchange taxation requirements exist. So it's an advantage, as you see there, because all the decisions are made within the same that same country. I worked for a company many years ago. I can mention a company called Lux International. They established in Switzerland. They were centralized entity. But what I've learned from them is they had factories all over the world. They had factories in Hungary, in Bulgaria, in the Philippines, in South America. Each of those factories produce different products to make the end product, which then gets imported or transported to every single country for trade purposes. Okay, but now each of those countries that were selling the products needed money or had money to bring back. The company in the middle, the centralized company, would control the cash, would control everything. We had to send reports, we had to send, I mean, sometimes out of the blue, they would request us, transfer all your money right now to them. They had their own ways and means in their own answers, their own specialized expertise to ensure that that money they require is maybe to transfer from this country to another country because they needed cash to buy stock, for example, and the exchange rate is better. You understand? Okay, moving on. Number 2, centralized cash management avoids having surplus cash in some banks and overdraft in others. Hence the reason I just brought the question about me having funds in my own company here in South Africa, and then the main company in Switzerland then said, no, you have to transfer this money out like right now. We require for buying that. All the money is basically controlled by them, okay, not by us. It avoids money being lost or misused or unutilized, because you may be sitting all the money here, but a company in India, for example, is sitting on overdraft when there is funds here. At what rate? Yes, at a good interest rate, but India, knowing that they have a developing currency, fluctuation currency, the interest rate is higher, and they're paying higher interest for being there. The organization will have a greater opportunities in short-term investments and in large volume of cash to negotiate a higher interest. Obviously, now the main company can negotiate with the bank, can go to the bank and call the shots. Okay, how much money they want, what interest rate they want, and so on and so on, because they have all the power of all these entities financing. Borrowing can be arranged in bulk at a lower interest rate. I can't explain that any further. This is quite straightforward, son. Okay. It will be more effective to manage foreign currency in a group companies in a central function, can be better identify opportunities of interest rate swaps. Okay. We will do now, after this, interest rate risks. And you will see what I'm talking about. When you have a centralized entity, it's much better to manage due to the fact that all the money being sitting on the one, and you can move money from one to another depending on how the interest rate is functioning, and also to as long as, and that is always important, in point number 1, as long as those decisions are lawful, because we can quickly do transfer pricing and transfer funds, which is illegal in certain countries, i.e. South Africa. It will be more managed foreign currency. I've said this one. Organizations will often hold capital reserves aligned with risk management policies for precautionary purposes. The reserve of foreign companies could be smaller than held separately by numerous individuals operating units. So once again, you're trying to build your little cash flow and your company is very little, and so on. You never grow out of it, where you can put it on the main company. You can bring suggestion as you need income and your reasons, and they make a decision of financing you. It's much easier than having the little entities all over the world with their own financing. Standardized procedures and risk management strategies could be introduced to monitor better. Standardized, so it will not be for per country, it will be one whole solid rule. Okay. Advantages of decentralization. I like decentralization for these reasons. Will be more responsive and needs individual operating units much quicker than the centralized. Centralized, there may be delays of money being transferred. They will be, maybe they don't have funds. Obviously, now you're sitting with the money in your own country, you can make the decisions right there and then. Quicker is available. Sources of finance can be matched by local assets immediately. You can't think about foreign exchange rates, nothing like that. It will be the currency in that country itself. Hence the reason why Coca-Cola's treasury departments are in its own countries. The managers of operating units can make a quicker, more effective decision as they will be closer relationship with its decentralization function, their own treasurer. Without delay, time difference in procedures is much quicker. Each region might have a different or distinctive tax regulation requirement, different financing conditions, and distinctive currency issues, which will require local knowledge and decentralization treasury functions. South Africa, for example, we have a distinctive, a separate, a different tax system that the UK has. Similar, but different. For example, you only allowed to move out of here at the moment 1.5 million per person out of South Africa. Okay? An entity, other than that, over that, you have to declare, you have to request permission from the Reserve Bank. There will be, even as far as possible, there will be withholding tax payable. Okay, years ago, what was this guy that went to the moon with a software company, South African guy, Shuttleworth, Mark Shuttleworth. He permanently moved to the UK. Now he's in the UK, living there, South African born. He moved all his funds from here. He had to, because it was so much money, he had to pay additional taxes for it. It's called withholding taxes. So they will say distinctive tax regulation requirements for each country. It's easier to just ensure you're working decentralization. So these are your different advantages of it. Okay, has come up in exams, more of a discussion question than anything else. Okay, so they will give you a question on cash management, and then within that they will tell you the entity is running a decentralization function, treasury function. Can you give me the advantages? The major advantage is the quicker response. It's better to work with a current currency, not foreign currency. Your assets value and your currency value is all the same. The tax is more controlled because you understand the tax of the entity. You don't have to worry about what is the implication to transfer pricing and all of that. Okay? So these are quite important. Does come up quite often in exams as a discussion question. Working capital, management policies, and financing. Okay? So as I discussed earlier, working capital. Now, forever we've been looking at balance sheets, and we always talk about the top half of the balance sheet, the asset section. We have the non-current assets and the current assets. So here is where we're talking about the current assets, but not only the current assets, we also have the current liabilities, okay, which is a working capital. Cash comes in, creditors is paid, inventories is purchased, debtors comes in, or we sell stuff on credit, and debtors pay, and here's a circle going, okay. What you're trying to achieve from these from this diagram, these four boxes there, is to ensure that it is balanced from month to month or from period to period. You can't afford to be out of cash. Just remember, this is the liquidity of the business. As soon as you're out of cash and you can't meet your creditors, you will be forced to either borrow long-term liability or sell non-current assets. Okay? So your liquidity, your working capital is imperative that functions in a smooth system. Okay? We will talk about just now about the aggressive method and the non-aggressive method, and how companies like Pick and Pay work on a aggressive method, and companies like ours a non-aggressive method, more conservative, and I'll explain why just now. Levels of working capital. Now here we're going to the textbook on 9.1, so we can please go to 9.1 of your textbook, please. Okay. So here we have permanent working capital and temporary working capital. Permanent working capital is a working capital that persists from time to time. So we will talk about graphs just now, but if we're going to be back in this year, is for example, we base our working capital from month to month to be 10,000 Rand or 20,000 Rand or 100,000 Rand, but it will be a permanent value that comes up. And regard there is fluctuation of the currency or sales or purchases, that is almost like our float from month to month is maintained. Then we have temporary working capital. That is one to do variation of sales, variation of seasons. Give an example, a ice cream company. Well, I wouldn't call it ice cream. Can you, I'm sure you've tasted Marcel's frozen yogurt. You don't have to give me thumbs up for that, but I'm sure you understand what I'm talking about. There is a seasonal entity. In winter, they sell lesser ice cream, although yogurt, being yogurt considered to be healthier, people in winter do eat. I, for instance, will, if I'm in the center, will go and buy myself one or so and so on, frozen yogurt, okay, despite winter or summer. But I think most of the sales, the bulk of sales, comes from summer. So that is where temporary working capital comes along. During that time, you require stronger working capital because you require to buy more stock, you require to pay more suppliers, you also receiving more cash, is more sales. So you must be able to control that. Okay. Net working capital, please ignore that. This is with regards to the hedging, which we'll quickly discuss, but it's not like examinable. So here is an example of what happens from quarter to quarter to your hedging. Okay, your working capital and your cash generative operation is the darker one. Yep. So as you can see, your working capital at the moment is quite low. Okay, but the cash generating for that same period was quite high, causing your working capital for the next period to be positive. Okay, somehow the cash generating in the next period caused it to go down, and so on. So bringing about a movement of that is a temporary working capital. What is happening with the working capital? It goes down to negative, goes up to positive, negative, positive, negative, positive. Okay. Once again, you're not going to be examined on the net working capital. It's just those two, permanent and working capital, temporary. The hedging. So, okay, it looks very, but if you have your textbooks in front of you, some of the things that's being skipped here. I'm just trying to see on my textbook as well. So if you have your textbook in front of you, it would be nice. (9.2) based on your study guides, hedging and matching financing. Okay, that is where we match the financing when it's low turnovers. So I'm looking at the permanent perfect hedging. That is when your permanent current assets, okay, is always maintained. That is this one here, your permanent current assets. That will be your permanent working capital. It remains steady, as you see there. Then we have your short-term financing, as that money comes available as is needed. It fluctuates, but it's always maintained a permanent working capital. The current assets is always maintained, and there's a fixed asset at the bottom. As you can see on the graph here, even though there's a seasonal change from season to season, there is always maintained. The conservative hedging is now here. You have a line. You draw a line. Okay. Okay. This is more of a. Sorry. Let's quickly read here. The perfect hedging consists of financing temporary current assets with short-term assets. So you financing the temporary current assets with a short term. So this short term here, you are transferring it to your current as it's increasing from year to year, from period to period. Okay, with short term assets and fund and fixed assets as well. So fixed assets also comes from there, by the way. but as long as the line is always above, so you can actually take on as we move along. The basic strategy of the perfect hedging is to match the expected inflow of outflow of funds. This method is considered sound financing because the inflow of funds and sale of funds being used is repaid the loans financing of the acquisition. So the more asset you pay, the more asset you're buying on financing and so on gets repaid, and it never takes out from your permanent your permanent current asset, but it is riskier. On this one, the conservative one, you actually draw a line, which we call it the short-term finance line. Okay, and the moment we go below that line, we start like worrying and start pulling back and start matching. Hey, we have to go back up again. Okay, but it's once again, it boils down to you still being above the permanent current asset. 6.2. Here in cash management, number 6 of your textbooks, we will now focus on the cash management function. Cash is regarded as the lifeblood of the business because without it, we cannot function. We cannot function the business, is what is moving and is always rotating. It is important to have much cash on hand since the interest earned on the cash is low. However, there should be also not cash shortages to borrow, as borrowing excess available overdraft in short notice incurs higher interest rates. I've explained that earlier. The treasury function relies heavily on accurate forecasting of financing of a business. When the treasury receives various cash flows forecasts from the business unit, they are consolidated as the shortfalls needs to be overdraft. So think about it. We have a entity like, let's say, the treasury of Coca-Cola in South Africa. There is different branches within South Africa. Coca-Cola, they have one in Cape Town, probably 1 or 2 in Cape Town, a couple in Johannesburg, a couple also in Mpumalanga. In every region there is. And then you have the centralized treasury, where it's constantly moving money from one side to another to make sure that the interest is always covered. Okay, that also happens with Pick and Pay and with Shoprite Checkers when it comes to from branch to branch, because they all belong to a corporate unit, to make sure that instead of earning interest, which is low, okay, you utilize the excess money of the one entity to move it to another entity for not to pay higher interest charges then. And only now and then you will borrow, depending on and based on how we said here, only now and then we will go below. Okay, here is some example of short-term financing, overdraft, call account. Okay, short-term loans, short-term notice 32 days, commercial treasury bills, and so on and so on. 26.1, don't have to worry about that. 9.3, the detail of 9.3. Okay, now these two formulas here. Okay, so I want to jump on 9.3 now. Liquidity preference. So these are your different types of liquidity modes. We have the transaction liquidity, the precautionary liquidity, and the speculative liquidity. You understand what liquidity means? It's having a cash, debtors, creditors, and stock liquid, okay? Not just being on overdraft, not just having too much stock, not just having too much debtors, is actually having a balanced cash flow, okay? That's for transaction purposes. Transaction motive, cash to carry out day-to-day transaction. The amount of cash held depends on the regularity of the receipts and disbursements during the day. This is transaction mode. The precautionary mode is balances are set aside for payment. Years ago, when I was doing my articles, I had a client that had money aside. For example, it's a construction company. When they, for example, invoice somebody, okay, like let's say a job of 100,000 rand plus VAT, 150,000. Well, that then it was 14%. But let's work on the fact that he's still 15% now, 115,000. He will take the 15,000 rand and move it to another account, okay, into a money market account, which is easy accessible. Going back to this subject, going back here is short term, okay, no notice, you can just take it out. But now when it comes to paying VAT, instead of borrowing money, it is already set in there. So he had it there for precautionary balance reasons. So whenever he invoiced a customer and they would pay, the VAT, he would move to that. Obviously, it's a bit more difficult, more complicated to do that in a business with many, many transactions, because to try and maintain that, sure, I think it's drastic, especially in my business that we sell every day on average about 1,000 invoices. It's very difficult to just take the VAT out and move it straight into that new account. What they've done here is they've taken the VAT out of maybe 2 or 3 projects in a month, which you can actually quickly control and move it into that money market, precautionary mode. So when it comes to paying VAT, we don't feel it. When it comes to paying, even when it comes to paying SARS and pay as you earn, the client always wanted a estimate of how much he should put aside, so he can put it in that bank account, so he knows what is available in the bank is to use, and what is put aside is for speculation purposes. Precautionary. Then we have the speculative mode, that is more for companies who keep large amount of money for exchange rate changes. Okay, if you have a big bank account with a lot of money for speculations, to maintain, to save borrowing money from the bank, or to save paying your suppliers abroad, and so on, or also buying stock. So you have a lot of money and you see a deal coming up across. That is what we normally do in our company. When we see that the customer or the supplier has offered us a deal where is a deduction if we purchase all the stock, we quickly have the money available for it, or else we'll have to borrow. So speculative, not so much long term, but it's longer cycles. The cycles are longer than the other two. Transaction is day to day. Precautionary is longer than this one, but it's kept for a rainy day. Speculative is for making deals and negotiations. Okay. Now here is the formulas that you are aware of when we did the sales analysis, which you'll be which you're familiar with, and this debtors time lag cycle, okay, which is your debtors balance, or your average debtors balance over your total sales revenue times 365, which will give you the number of days, okay, that you compare to year and to see how your days, if you can decrease the days, the less the days are, the quicker you move in that wheel. Remember that wheel we discussed earlier here. So we must turn around this wheel. I don't know if you're aware, there's a company called Giant Cash and Carry here in Cape Town. I don't know how many of you students are here from Cape Town. I'm hoping it's all of you. And you're all aware of that company. They are cash and carry. It's almost like a supermarket, but in a bigger basis, okay? Like a macro. And their secret is they have a lot of products, and they have a markup on their products of very, very small, 1 or 2%. I mean, on 100 Rand, they will make only 1 Rand or 50 cents. I mean, we say to ourselves, how can these people survive? I mean, they have to put so much capital money in there. It's not that. They have this wheel running. So they may be making a 0.5% or 1% markup on the product, okay? But that 100 Rand circulates maybe 100 times in one day, over 365 days a year. I can't tell you how much money is that. So what this person is doing is bringing the prices down as possible and managing this wheel as quick as possible. You understand where I'm coming from? So the percentage is low, but everything is sold in cash, pays his creditors on time, stock is purchased, there is no debtors is gone, it's only cash, and it's a quicker wheel, not because data is a bad thing, but it's a quicker wheel to move. And the quicker you move that wheel, the quicker you buy more stock. Maybe they can go into a scenario where they don't need creditors and they're paying in advance. Okay, so they're moving that money and they're moving that 1% and turning that 1%. Let's say you move it 100 Rand in a day. You do the maths. 1% a day times 365 days, and you have 100 Rand. You would have at the end of the day, at the end of the year, 365 Rand plus another 100 Rand. Okay, now let's talk about big figures. You had 100 million, and every day you're getting 1%. At the end of the year, you have 365 million plus your million. Okay, so that is 1%, turning it quite quickly in one day. These people turn this in one day, maybe 10, 20 times. I just gave you an explanation, you're turning it once. Lower markup, moving as fast as possible. Takes a lot of skill to do that. It's not anybody can do that. You must have a lot of capital intensive to start up a business like that, and you must have a lot of context to buy from, and your customer line must also be there. Because the one thing you don't want to do is keep stock, because the longer you keep the stock, you're losing money. So the whole thing is turning. Okay, so going back to this again, the quicker you reduce this formula, the better it is for you. The raw material time lag, the quicker you turn this, the better for you. So at the end of the day, the business cycle must function as fast as possible. Greatest time lag. You got to now be smart about that now. You can delay credit as long as you are not charged interest. If you are charged interest, then your delay tactic or the credit is going to count against you. Okay, you can delay credit. Okay, so that one is questionable. Okay, next one is work in progress time lag. That is basically the movement of your production. The quicker you produce, the less overhead you can have, the more you sell. So that's also important. You don't want to spend a lot of days, and you also don't want to be a mass production entity. We're producing products at a low quality. You must maintain the same quality, but then again, be more efficient. So as you can see, all of these operating cycles, if we can minimize it, it will just improve that cycle we spoke about here. Okay. Last one, the finishing goods cycle. Well, it works exactly the same as the working progress. So the goods come in and get sold automatically. As they come in, they don't sit in the warehouse, they get sold quickly. Okay, so here they have the cash operating cycle. Sorry, there's a few letters missing there. I'm going to read it from my own textbook. The cash operating cycle is defined as the overall time lag between cash paid inputs and cash receipts output. B plus C plus D plus A plus E minus C. Just remember, C also counts against you. Okay? So here is what they are currently doing, what a time lag that they have. We have the creditors. If you look in your textbook, maybe more clearer. Okay? What is happening between all the cycles together? Creditor cycle, stock. Creditor cycle, stock cycle, debtor cycle, the net effect. Your net effect should always be, well, try to always be positive, because you're trying to bring these days lowest. Your net days must always reduce. So look what is happening here. 13 days on first quarter, 8 days. Your second quarter was quite nice. Okay. Your third quarter is steep, bad. Your fourth quarter, okay. 2013 first quarter. Sorry, here it is. It's not quarters, halves. Your first 2012 first half was 13, great. Second half, much better. Your third half, it got worse. On your 2013 second half, it got better than the first half. So I'm picking up a trend here, people. Look what is happening. That is probably when you do most of your purchasing and you're stuck with paying and beginning of the year, and your second half closer to Christmas. This is more like an entity, a buy-sell entity. When it gets closer to the year, you have more money and people are buying more. The day collection is quicker, and so on. Do you understand what is happening here? Can you see what I'm talking about? What is happening to your days? On quarter number 14, the last quarter, 11, still quite high, but acceptable. It's getting better. Okay, it's better than the previous year, 12. Okay, are you all with me? Thumbs up on this one? Any thumbs up? Anyone? No one. One thumbs up. Thank you. So you're understanding what is happening here. Your aim is to reduce the number of days. Okay, moving further, they want that we did 9.3. Now we're going to 9.3.5 and 9.3.6. This theory, the Baumol model, cash management, investment in cash and marketable short-term assets are the same practice as investments and inventory. Both requirements a minimum level of inventory and cash holding of cash balancing outflow. Safety inventories is required to meet the unexpected demand. In addition, amounts may be required for future growth. Sorry, people, I see more students are coming on board, which is fine. Just remember the attendance register is there to be completed. Okay. So here is a method of how you can base your liquidity. So I want to quickly, here is the whole question of Mr. Price liquidity. And from here, they developed this formula. You're not going to be asked to develop the formula. The formula is there. Q equals to the power of 2BTI. Here is a question coming up. You need to find out what is the optimal withdrawal. How much is the most efficient withdrawal you can take off the bank every month. You don't want to take too much because you're going to reinvest it and there is interest rate to pay and so on and so on. So Merton Company knows that the total demand, which is T on the formula, total demand next month will be 300,000. So once again, going back to that example of cash flow that this guy is working on precautionary method, putting money aside because there's VAT, there's taxes, there's pay as you earn to be paid, there's suppliers to be paid. Now, this is what you base your information to. There is a budget created and you know what your demands are. It's imperative that you have the budget. Okay? And the fixed cost per order converting the marketable security into cash is 50 Rand. So from your fixed cost, so your money market or something, it's going to cost you 50 Rand. The interest rate on short-term marketable security is 20% per annum. Okay? Calculate the optimal withdrawal size. So you need 300,000 for next month. As 1 month period, the specified equivalent monthly interest rate is determined as follows. So because we say 20% per annum over 12 months is 1.67. So it is imperative that they say here per annum and they're working for withdrawal size of 1 month. Okay. So we will put it all into the calculator. 2BT, B meaning the amount of cost to borrow, to take the money, to withdraw the money like the bank charges. The amount needed, 300,000. It will always be a fixed number 2 there, times 2, over the fraction. Now, remember, that is, you can write 1.67%, or you can write, don't write 16.67 or 1.67. We are working on a percentage, so they actually turn that into numerical. So it's 0.0167. Or you can say 1.67%. But because there's no percent after that, it's 0.0167. Okay? You work out the calculation, comes to 42,427. Okay? The limitation of that model, the discrepancies with this model is that assume the firm will have a constant cash requirement, and that is not necessary in practice. As I pointed to you earlier, VAT is paid every month for a company who makes over 50 million in a year, then it's understandable. Tax is paid once every 6 months, so it's not going to be applicable, it will fall away. Provisional tax once a month, pay as you earn every month, that's fine. Creditors every month, it's fine. But seasonal business, this formula will not work. Okay, so that is the discrepancies. Why not using this formula on all? Okay, so for seasonal business, out of the question. Okay, look what is happening here. When it's seasonal business, you're required to use the Miller or model. You can't utilize this model. This model is for a constant requirement, 300,000 a year that you require. So the next one. Here is the next formula. Z is a bit more complicated. There's a to the power of 2, which is q to the power, small q to the power of 2. I take that into plus b. Okay, and there's an I for interest there. And there's a 4 and a 3 that has to be there. The upper limit, okay, is 3 S's, 3Z. So you at the moment trying to find the final solution. The final solution is let's find Z. And once you substitute Z in the formula here, then you work out B. And then after you substitute Z, you have the answer for B, you substitute Z and B into this formula, and then you get the average cash balance. Okay? The average cash balance here, 42,427, when is a constant requirement. On this one, we need an average cash balance with fluctuations. Okay? So here is, and this one is involving probabilities as well. Okay? Look what is happening here with Miller or Moore deal. The company A invests in all surplus cash at an annual rate of 20% per annum, incur a cost of 15 per buying and selling transactions. The expected daily balances and probability distribution are as follows. For 8,000 Rand is 10% probability. That is the probability over a period, over a year. So going back to this, okay, the first example here, that which is the Baumol model, it's balanced. One straight figure required, like they say, 300,000 a year. It doesn't change. So they will borrow this every month. They will meet their annual requirement. Okay. On this one, because there's fluctuations during the month, they work on probabilities. Okay. And here they say the probability of you requiring 8,000 Rand a month is 10% probability. 9,000, 20%. 10,000, 40%. Now, these probabilities, if you get a question that doesn't make sense, will be given to you. The acceptable lower limit holding is 2,000 Rand. We need the lower limit holding to subtract it. That is like your bottom line. To subtract it from your net. So, take the first one, for example. Now, we do the calculation as required. The determined cash level of Z is as follows. 10% of 8,800 Rand, 20% of 9,000, 1,800. Remember, you must have a 2,000 Rand limit all the time. 800 Rand, that means the cash means you require is 2,000. Why I say 2,000? Look at this. Cash in the bank, 8. We're going to be minus by 2,000. Cash in the bank, 9. We're going to be minus by 1,000. Why I say that? is because 10,000 is the required rate. So 10,000 minus 10,000 minus 8 is minus 2,000, minus 1,000. Then 10,000 times 40% is 4,000. There is no cash mean. Okay, 2,200, which is 11 times 20%. 12,000 times 10% is 1,200. The cash means is positive because we have more. 11 minus 10,000 is 1,000 positive. 12 minus 10,000 is 2,000 positive. We then do the calculation. That's going back to the linear regression analysis. Okay. Cash means, that is a cash mean, is square rooted 4 million. So it's 2,000 square rooted 4 million. 1,000 square rooted 1 million. That one is 0, 1 million positive, 4 million. We then work the P, which is the cash generated times your cash means. The probability is 10% of 4 million is 400,000. 20% of 1 million, 200,000. 40% of 0 is 0. 20% of 1 million, 200. 10% of 4 million, 400,000. We add everything up, comes to 1,200,000. Just remember that that square root amount here is that cash means that we have here. And then the P is a probability value. Okay? So once you have that figure, you put it on the formula. 350, going back to the formula. B is the borrow, and the EQ is the 1.2 million here. 4 over, that is 0.5%. That is when they have taken the interest rate. Where's the question? Here's the question. How did they calculate the interest rate? Oh, here it is. Because it's per day. 20% divided by 365. 0.00555. That is per day. Okay? Plus the 2,000 that we require to have holding cash all the time. Square rooted comes to a total of 6,341 rand that we require for Z. So we then substitute Z into the second formula, 3Z. Now 3Z, the Z is now how much? 6,341. And we are looking for B. We do it in an algebraic form. Sorry, no, we're looking for A. Two times 2,000. 2,000 is the limit. Yes, the holding 2,000. So then we have 15,053. Therefore, B is equals to 2,000. But we already knew that. Now we put that on the average sale, on the average amount, which is how much the limit we require per day. So take into consideration the question is done per day here. It doesn't actually say, does it say? No. But this is working over 365 days. So it's daily. Okay? So we take the average to be then 4,687. The fact that I see here a regression analysis, I doubt that this is going to come in exams. You'll probably see this coming up more on your assignment. Okay? They are not going to give you a regression analysis question in exams. It's too time consuming, calculation consuming to spend a lot of time on. Debt management. Okay? Debt management, what I want you to take note here is what is happening to your creditors. Okay, here they give you example credit policies, what does Mr. Price towards credit policies are. Don't worry about that. Okay, what happens to Mr. Price receivables? Here, start the question is here. Mr. Price trade receivables are as follows. So here we have to take into consideration what happens to our trade-offs, what happened to our debtors at the end of the year. Okay, so Mr. Price trade receivables are as follows. The gross trade receivables is 1.2. That information given to us and at entity 5. The impairment provision given to us as well. The net receivable is so much. Now, the aging of the gross trade receivables are as follows. Current, 30 days. Bearing in mind that all add up to that. This is your data and age analysis, and it comes to that. And then you have an imperative, the impairment or the bad debt or the provision for bad debt. Okay. Sometimes it's a percentage of that, or it can be actual. You have to pinpoint it. Okay. Now, the interest charge of outstanding accounts, and according to the National Credit Act, fluctuates in accordance with the legislation, with legislative changes of the repo rate. Okay, the group has provided receivables in all aging status levels based on estimate recoverable amounts from the sale of merchandise and determined by reference in the past experience. Comment. Higher interest income on debtors accounts should be compared to the charge related to provision of credit. So you can't overcharge because the National Credit Act will come into place. Analyzing. The debtors book at 9% a year. Yes, sir. No sequel. Gross debtors is 9% per year. And the mortgage is 4%. Secured 12, unsecured 53%. Okay, so that is what they tell you it's supposed to be. Okay, so what they eventually require you to do is do a calculation on how much cash you have. It's going to impact your debtors collection, if it is doable to keep running debtors, or is it better to give a discount to debtors for them to pay faster and avoid the interest rate charging. Okay, so you can get the money faster. And you will see that, I think, is on the next question, if I'm not mistaken. So I was going to see if the question is here. Yeah, it's actually this one. Is it the impact on interest rates? Okay, so what happens here in this question is obviously the company budgeting 1,000 units of products, selling at 50 Rand per unit. Manufacturing cost is 25 Rand. So they see that this is their markup. The contribution per unit will be then 25. The manufacturing cost is 25 and 50 Rand per unit, 25 is contribution. When the sale is made in credit, the company will incur a collecting costing of 1 Rand per unit sold. The weighted cost of company is 15%. Now, by the use of the formula, you will see if what you are making is worthwhile doing. So you use the formula with regards to is it worthwhile maintaining that? Are you still making a profit? The selling price is 50 Rand. The cost is 25 Rand. That means you're selling 1,000 units. The product is 50, which is 25. The contribution times 1,000 is 25,000 Rand. That is your selling contribution. Okay. A, all sales. B, all sales are made in credit accounts paid over 30 days. Okay. So if they are paid over 30 days, we have 50 minus 25 times 1,000, which is 25,000 Rand. The cost of carrying the cost is 1 Rand for every unit, 1,000 Rand. The financing, because you have to borrow the money, because that 25,000 Rand you would require to refinance, but now you're going to lose it on financing. So you're going to lose that money on financing. So we now have 15, but just remember is in days, okay, and they're working on 30-day and the question is required over 30 days. Yes, it should say yes, paid over 30 days. Okay, so we will then take the 50 rand, which is the interest, the 15% interest times 1,000 times 15 over 100 over 1 times 30 over 30 days comes to 616 rand 40. Then the net profit will be 23 rand 384. So if you decide to sell it on cash, you only can achieve that in your pocket, where you will be achieving that if you sell it in cash. So the next thing you can take note, and that is a question for the exams. I wonder if they do have it here. I'm actually looking for that one. The sale made at 2%. Aha, there it is. Sales are made at 2% discount and is granted in accounts paid in 10 days. 50% of the data take advantage of the discount. Now that is what you would be up to in exams. When sales are made on credit and there's a discount. So they give you the one cash sales, the one on credit, and the one when they say 2% discount and 50% of the creditors or the debtors will take the discount on, will be paid on time. So look at the exercise A. It's going to cost you, you're going to receive 25,000 if you sell it in cash automatically. On B, if you sell it on credit, you're going to receive 23,000 rand because there's cost of capital here of 15%, and there is also cost of holding of 1 rand per unit. Okay. On C, if you give a discount of 2 rand, okay, 2%. So the discount of 50 times 50% times 2% of 1,000 is 500 rand discount. So on your total calculation, the lag period of 10 days, your interest is obviously not going to be for 30 days, but for 10 days. It's 102 rand plus that. So it's only 410. Okay. Holding stock of 1,000 units is 1,000 rand. So it gives you then 23. Now you then make a decision which one to use. So you have done this one, cash. You have done the one maintaining the full amount on credit, and you've done the one with a discount. Okay. And now you assess the situation. Which one will be the best option? Cash will probably be the best option, but we're moving up with the business, so you have to move into credit, unfortunately. That's how the world is moving into. So this will be the next option, okay, for the 30 days. The other way to absorb that 15% here, people, the other way to absorb is to push the 15% to our suppliers, okay, where we tell our suppliers, give us a discount on the fact that we are getting our money from our debtors later. Or you can tell your suppliers you will pay them 30 days later. So you can absorb that 15%. That's when you're setting off your current liabilities versus your current assets. That is not for this exam, by the way. Okay. Here is okay. Here's another one, which I want you to take into consideration when doing this one. This company have a change in policy. They move from one policy to another. The new policy, they're going to have a discount of 2% on 60% of the sales they're going to take advantage of. Okay? But by doing that, the sales will increase by 500,000. And that 500,000, 50% will be a 2% discount. At the end of the day, this is what I want to pinpoint for you. The income received from current is higher on using that method, but the new policy is a lower amount. But because you're giving credit and you're forcing the people to give you a discounted paid up, you actually increase sales. You may even turn around because there is a discount in place. And we, you, I, all of us are guilty of that. Okay? You go to Pick and Pay today and you see the washing powder, usual price, 90 rand, and it's going for 79.99 today. You will buy it. Even if you don't need it, you will buy it. If you have the money, you will buy it. Pick and Pay will just smile to that. Why will they smile? They're getting more cash inflow. They're moving money. They're changing the system. And that is what is coming along here. The fact that when you give a discount into place, sales automatically increase. Okay? more cash is moving. So overall, your income has now increased from 417 to 477. So the question is it worth it? Yes, it is. The other thing you have to take into consideration, have you taken into consideration the increase? Do you have the resources to meet that increase? The capacity, do you have the stock, do you have the labor, do you have everything available to meet that increase? Okay, this is what you have to take into consideration as well. And if you don't, and you have to buy from or have additional costing involved, you have to take it into consideration as well. In this one, they have bad debts as well. So this is a question that maybe you can mark for revision purposes at home. We don't have many questions on this one in your study guide, but there is one here: changing credit policies, changing from the one to the other. But the other policy has caused an increase of sales, which is interesting. Okay, quite interesting. Just remember, with everything that you do, there must always be a conclusion. Even sometimes when they don't ask you, put a conclusion down, you get your marks for that. Okay? They didn't bring any conclusion. Deferred factoring, don't have to worry about that. That's not going to be examined in the question. Okay? Debtors management have done that. 9.4.4 that we have just done. Dividend decision. The only thing you should know about the dividend decision, the owner requires a rate of return on investment, while the managers are more concerned about the going concern of the business in the organization. Shareholders value rate of return, the return increase by the dividend that the shareholders receive, capital growth and value on the share over time dividend. Can you remember the definition of growth? G on the formula. Okay, G is basically your KE, your BR, your rate of return, less your dividend payout in what is left over. So what your required return is of your shareholders after they get paid. What is left gets added back into retained earnings. That retained earnings gets compared from year to year, and that is what they call growth. How much is that retained earnings left over is G, and this is what they're talking about here. The owners are only interested on what they're returning on the investment. So if they say 16%, 15%, as long as they get their money, they're happy. Okay? The managers are concerned of the going concern of the business. So they're concerned on what is left over of the business. There is no questions related to that. For enrichment purposes, don't have to worry about that. And that ends this chapter. Let me see if there's activities. No, there is no activities for this. Okay, so going back to revision purposes, I would suggest you please just revise this example that we just went through very quickly. Okay, go through this one with a discount factor and see how it impacted, and then do the same one here, taking into consideration a new policy. This is more or less a question in exams. Okay. Remember the non-financial factor questions that they're going to bring about here, because there will be discussion questions. If they give you a number crunching question like this, they're going to say to you, what impact will it happen to the business if you decide to take the 2% increase in sales, an increase in sales of 500,000? The one impact is capacity, okay, that you have to talk about. Okay, with capacity comes a whole broad other things, capital necessary, availability of labor, availability of stock, capacity in the warehouse, transportation availability, creditors maintaining punctual time to meet deadlines, because the demand will be there, 500,000 additional. So all of these are discussion questions to bring about. Okay, that ends that chapter, people. And the next one is currency interest rate, which is the last chapter of the syllabus. Okay, now here is interesting, where we are going to be asking you about the current risk and calculating interest rate, and have you ever heard of the repo rate, and so on. Okay, so that is chapter 15. current risk is defined. You can read about it. Current risk defined. The enterprise is being, okay, the risk of the foreign rate can be defined as a potential financial loss of an enterprise due to adverse movement of foreign exchange rate when involved in an internal transaction. This is the risk that we are putting money into a foreign item that it might not be profitable. Okay. In our business, for example, we buy products from abroad, as I said earlier, and it is on foreign money all the time. We have stock in our warehouse that we bought with foreign money because we exchange it to foreign money and buy the stock that arrives here. We then base our price on the current exchange rate. But if the exchange rate improves, okay, in other words, the rand becomes stronger, that means my stock that I have in the warehouse that I bought it when the rand was weak, okay, I cannot sell it that because my competitor will now buy with a stronger rand cheaper products, and I will get stuck and I will have a forex loss. Okay, so this is a risk when it comes to fluctuation currency. So if we all go to that chapter, financial ratio, we're going to be talking about the difference currency quotation in current markets, different currency quotes in current markets, which is basically this here. Now, you have heard of financial losses, financial risk, and FECs, okay, a spot rate included. I'm going to read the question to you. You have done a similar question in 260102. Now you're going to do this in 3702. It goes as follows. A local furniture store, Shaka Pty Ltd, imports furniture from exclusive manufacturer in Europe. The last order was placed on the 30th of June 2017. The furniture to the value of 250,000 euros, which cost on the 30th of July. So that is when the order was placed, 30th of July, order placed, okay, for the value of 250. So this is what you must pay them. So this is like a factory there, a shop that side wants 250,000 euros for that purchase. The shipping terms are free on board, which means as soon as it enters into South Africa, you will pay the bill. So at the rate it arrives here, free on board. The furniture lands in South Africa on the 6th of August 2017. So from that date, on that date is the amount is due. The payment terms are 30 days of the shipment. So, sorry, for this. FOC would mean free on board, which means at the date you put the cost of the product in your books. Free FOB, sorry, FOB. So, for example, the cost price of the stock will be valued at 150765. Bank selling rate, not buying rate, bank selling rate, because we are buying US dollars or euros in this case, so they are selling US dollars to us. So it's not buying rate because we are buying. That is the bank. So we are individual buying foreign currency, so it's a selling rate to us. Okay. 30 days. So Chaka makes use of FECs, hedging against the fluctuation. So bear in mind, he's getting paid 30 days. So from the date they place the order, an FEC is taken. From the date they place the order. So they place the order at 15.0097 and is paid 30 days later after date of arrival, after FOB. So on the 5th of September will be paid. Okay. Here they ask you, A, calculate the rand amount due to date of transaction. Okay. So we bought it for 250, 1507 at the date of transaction when it arrived. It arrived on that date. So in our stock books, we will have 3,769,125. That will be in our stock books. In our balance sheet under creditors, we will have 3,765,125. That's what we will have. B, assume no FEC is taken out and exchange risk, the exchange rate risk calculate the foreign currency gain loss between the transaction. Now, just remember it's paid 30 days later. So it's paid on that date here. Okay, so if they don't take FECs, it will be paid here. Just look what is happening here. They could have bought dollars or euros at 1507. They bought it at 1555. So there is going to be, and they're buying it at more expensive. There is going to be a forex loss. B, 1507 minus 1555 equals 120,000 forex loss. Now, in the exams, they're not going to ask you journals, as I said before, but you need to understand that for purposes of management, moving forward is your business, moving forward was your understanding. Okay? That 3,769,125 Rand is on your stock. So you can imagine debit stock 3,765,125, credit liability 3,769,125. Okay, so you have credit liability. When you paid it at the date of payment, you must put in credit liability 120,000, debit forex loss in income statement 120,000. It doesn't affect your cost price because we're working on FOB. It affects your forex loss on the income statement. Okay, 120, 125. Okay, your credit that you're paying now is going to be worked out at more expensive by 120,000. So it will be 3,769,125 plus 120,125. So it will be 3,889,250. Okay. C. Determine what would have been the benefit if they take an FEC. So just look at what happens here. So FEC is they decide to take it at 15.1582. You see that? FEC from the 1st of August, 15.1582. So that is the rate they're paying. FEC is usually more expensive than spot rate. At spot rate is 07, FEC is 15. Okay? But if they kept it at the spot rate, no FEC, when they do pay it, they pay it at 55 cents, even more expensive store. So you can see here, the FEC will be a benefit compared to paying it without FEC. Okay? Let's look at the calculation. Here they say, effective $250,000, 1555 minus the FEC amount. There will be a gain of 99,700 Rand. Okay? Because they took the FEC. Interesting, eh? Now, I want you to just go back 1 year, South African economy. Last year, this time, not even this time, actually this time, the exchange rate was like 19 Rand to the dollar. In some cases, even close to 20 Rand. If somehow any foreign company, local company buying imports would have taken FECs to pay something for 6 months or 8 months or even a year at the rate that it's stipulated then at 19 Rand something, they would be heavily in trouble now because the exchange rate is 14 Rand. So that worked against them. Okay? So it's a gamble, has to say. But here is your answer. Later on, you will see how we calculate the FEC rate, by the way, by imperative of inflation or imperative of interest rate. Okay? Moving forward. Yeah, D, sorry. Calculate the mid-rate 5th of August. So this doesn't usually come up in exams. I've never seen this in exams, but it is taking the buying and selling on the 5th of September. So buying and selling, there's a 2. You take the 2 up and you divide by 2. It's basically these 2 up. There, the buying and selling divided by 2. That is a bit useless information. But yeah, okay. The theory factors, That is what we're talking about, imperative and purchase power. Okay. A direct relationship exists between currency and interest rates that we know. The currency and interest rates. So the more you borrow, or the more foreign currency is required, okay, the higher the interest rate is going to be. So let's go back to South Africa, 2020. South African production came to a standstill. When we went into level 1, all companies must stop working, and only the essential entities can work. So all exports were stopped, all imports were stopped. Only essential entities may work. Okay, hospitals, companies that make bread and so on. But export companies to bring stock in must stop, import must stop. So that means we were not buying from outside. There was no need for us to sell our rands for US dollars. We were not selling to outside, so we weren't selling, but we were in need of currency because we were functioning. Our company, or our country, as I call it, a company, was requiring fuel, was requiring medicine, was requiring financing from abroad. Okay, so we were requiring US dollars and euros, and we were not requiring to sell our euros and rands. So we were not selling. So because there wasn't any production happening, so we were just borrowing. In other words, that caused an implication in the currency because there was a demand for US dollars in South Africa, and there was little US dollars coming out from the US because the US was also in trouble. It's a global thing. Caused the exchange rate to jump up to 19 to 20. Okay. Now, as soon as production started, we started selling our products out abroad. Our exchange rate got better because now we can balance things out. Hence the reason why things started getting better. We had that scenario in Durban a couple of months ago, the looting and the disruption that went global. All over the world, they talked about it and so on, and started talking about how risky it is to put money in here. All of a sudden, there was a slowdown on selling or requesting of rands outside. The exchange rate was fluctuated again. Okay, wasn't so much, but it did. We're back on again, getting established again. So there is a drive, or should I say, there is a relationship between the two. Always, the exchange rate is always being influenced by inflation and interest. Always. Sometimes when we talk about the exchange rate, the interest rate in South Africa at the moment is very low, as we all know. It's like 5.5 of I think 7.5 to 7% or 7.5. What do you think now? To the repo rate. The moment the dollar currency start increasing again and the rand start depleting, you will notice immediately the interest rate will rise. Why the interest rate will rise? Because it's calling from foreign investments to put their money here. Please bring your dollars back here. We require your dollars back here. We're offering you guys more interest. The bad part of that wheel is that the individual, you and I, that are locally living in South Africa will suffer on the interest rate hike. Okay, so the answer to that is a short-term solution. We can't, for example, increase interest rate because there is a demand for US dollars outside. Okay, the moment there is a demand for US dollar, all we have to do is produce more. So there is a demand for US dollars outside, but we are selling also, which brings more US dollars into the country. Okay, maintaining the exchange rate low. Okay, sorry, just have to give you that information to see for you guys to understand the implication of the two. Interest rate is associated with the rest of the country influences direct foreign investment in the country. This in turn drives the supply of demand in the currency, and therefore the value of interest parity normally uses to calculate the exchange rate in the short term, while the purchase power parity is used to calculate exchange rate in a medium to long term. Countries like, for example, the UK, the USA, where the currency is very stable, okay, they will use a purchase power parity. Imagine we were a purchase power parity. Nobody would have stopped us, basically. Inflation affects the future value of the investment, therefore, is either drivers or discouraging investments in a specific country. The effect of inflation rate differences between two countries on their exchange rate is called purchasing power. Now, here I'm going to show you guys an example of the interest parity. Okay, this is the interest rate parity. To calculate the exchange rate, the rand value in South Africa. Look at this. The following information is available to you in South Africa currency of 5th of September 2016. A spot rate, 16 Rand 04. That is a spot rate on the 5th of September. South African borrowing rate, 8.5%. It's not bad for art. In South Africa at the moment, we are 7% prime, but it's 8.5 at the moment in the question. The United Kingdom, 1.5%. At the moment, there is 0.5, by the way, but it's 1.5. The South African rate of inflation is 6.3%. That is bad, but yeah, it's more or less realistic with what we're currently having. The UK inflation is 2.8. Assume they are working on 360 days, okay? Use the interest parity, in other words, the interest rates here, not the inflation rate, to calculate the forward rate of 60 days. Remember earlier on the question here that we had about FECs here, where we had the spot rate at 15.075 and the forward exchange at 15.15. How to calculate the FECs? This is how they calculate it. Depending on the country, they either work on inflation parity or in an interest parity. South Africa in interest parity, unfortunately, short term. So here is a calculation. The forward exchange rate is one. Just give me 1 second. Just hold on, please. Excuse me, sorry for that. The forward exchange rate at the spot rate is, the formula is a spot rate equals to 1 plus interest rate reference currency plus interest rate base currency. Just remember, the interest rate base currency is a foreign currency. The reference currency is a currency in South Africa. Why we call it reference? Because it's the one we are working with, 1604. If that was a US one, that would have been the reference rate. Okay? So we would take then 1604, that is a spot rate, plus the 1% over the interest rate of 0.85 over 60 days of 360, and do the same over the interest rate base, 60 days of 360, then you know that then your answer will be then your forward exchange rate, 16.22. So going back to that question here, there tells you what is happening. You borrow for 15.85. So let me explain this wheel to you. Why are they doing this? Why they have to do this calculation? This is a company in South Africa that is gonna buy a purchase from abroad, okay, at 1604 right now, okay, but they're buying from outside. Because they're buying from outside, people, they require a different rate. Okay, why they require a different rate? Because the country outside, the bank in South Africa, is going to take their money, is going to put their money in their country, make interest for 60 days. It's going to change it today for 1604. It's going to make interest for 60 days and then pay it to that other supplier on that side. In South Africa, the bank is going to take money to pay that 60 days abroad to make interest at 1.5 and to pay interest in South Africa at 8.5. Hence the reason why it is more expensive of FEC because we're gonna be earning interest for 60 days. Not we, the bank, the South African bank that taking the money abroad on your behalf. It will be earning interest at 1.5, and by sending money over there to borrow interest at 1.5, to receive interest at 1.5, they will be borrowing from South African currency at 8.5. That is why it's more expensive, and this is why your FEC becomes 1622. Most cases, FEC is better, 1622, but if the exchange rate keeps on depleting, you will notice that you can benefit on this. If it improves, then yes, you're going to have to suffer, unfortunately. Okay? The next question, use the power pairing. So in other words, it's a similar formula, but we use the inflation rates into picture. Look what is it? Forward spot rate, 1604. Inflation rate, 0.63 over that. Unlike the other one that we divide 60 over 365, we square rooted the amount, and we calculate to be 17 Rand 15 cents. Why they don't have 60 days? That is per year, is long term. Okay, the parity rate. We can see it right now. You can do the maths right now. Inflation rate abroad at the moment in the UK is about 1.5. South Africa is 5.3. You take the spot rate right now and you can do the parity rate, and you can base it on how much right now is the exchange rate to the US dollar. What would have been 17,715 at the moment? Okay. Next, hedging currency. We almost finished with the chapter, by the way. For 3702 purposes, we're not going to focus on money markets hedging on forward exchange. You're going to forward on forward exchange hedging only on these two techniques. Forward exchange hedging, it's not money market as well. Yes, money market because of the cash flow. Yes, because we do cash flow on this company, on the syllabus. Yes, we do. So the other one, currency swap, foreign exchange options is the other question. Future option is the other question. It's just only the first two. Hedging currency. Here's one of hedging currency. What happens with hedging currency? When you take the South African rand, you take it abroad and it comes back. What happens to that exchange after 90 days? Okay. So let's read the question here together, if you don't mind. In Tunga Pty Ltd imports tiles from overseas supplier, 10th of June 2017. In Tunga Pty Ltd receives invoices to the amount of 250,000. So they are importing tiles. Money is coming, stock is coming in from abroad. So we receive an invoice to pay of $250. Okay, the following information is available for us. The exchange rate, the spot rate is 9 Rand 47 to the US dollar. That might have been a very long time ago. I would say 2007 rather than 2017. Okay, the South African borrowing rate at the moment is 90-day borrowing period, 8.5%. Take into consideration is 360 days. South African investment rate is 4.76, so to invest money. American 3.3 to borrow, 0.72 to deposit. Okay, so here you can do hedging. You're gonna take your money, you're gonna take it abroad, and you're gonna bring it back. Okay, in Tunga Pty makes use of the money market hedging to market risk related foreign exchange rate fluctuation. Interest borrowing and investment is determined in adding the borrowing investment at the end of the period. The rand amount payable 18th of February, September 2017. That is the date of payment. The date. What is the rand amount that you're going to pay? So here you have to use the financial calculator because you have to now work backwards, bearing in mind that you have taken the $250,000. You have borrowed it from South Africa. You have taken it out of South Africa, and taking it abroad and you putting it in a bank there for 90 days at 0.273 to pay them on the 18th of September, the $250,000. And in South Africa, people, you're going to be paying interest at 8.5%. That will then take into consideration what the total cost is, and then we divide that by the amount of dollars to calculate my new effective exchange rate. So here what I've done. Future value on your financial calculators, 250,000. Period of interest, 1 period, which is 3 months, because it's every 3 months maturity, 0.70. If that was, for example, not 3 months, if that was, for example, 12 months, you would have to divide that by 12. Remember that. Because it's 3 months, you see here, this per annum. Per annum, we will have to divide that by 12 and times that by 3, or divide that by 360 and times it by 90. Okay? Intuga needs to borrow funds locally in June 2007 to convert them immediately to US dollars and invest them in the US currency to ensure there's enough value to pay 250 on 18th of December, September 2017. Therefore, we must determine how much Intuga needs to invest in based on the return of 0.273% in 90 days. So how much they have to invest? $249,000. So today, or should I say, 10th of June, they've taken $249,000 in South Africa and put it in the USA. Okay, that's example 1. The next part is, people, is how much is that money costing us in rands, and we're going to borrow it from the bank in South Africa. The rand value, we're talking about the rand value in effective. So here, we require $249,319 rand at 9 rand 0.947, which is 2,479,976. Now we work again backwards. That was the future value of 250. Now we work, the present value is that. What would be my future value? Here in the scenario, we know what the future value is. We're trying to calculate what the present value is. On this calculation, we know what the present value is, what we need to borrow, but at the interest rate of 8.5%, 90 divided by 360. You see that? So you take your 8.5 divided by 360 times 90. So the interest rate is 0.0, or should I say 2.12%. That's what the interest rate is. Okay? The future value is 2,532,000 rand. So that is what they have to borrow. They have to have in their bank. That's how much the stock is going to cost them. Okay? So the effective rate, people, if you take your calculators now and take 2,532,675 and you divide that by 250,000 euros, gives you an effective exchange rate of 10 rand 0.13 to the dollar, not 9 rand 47. So you understand what they have done here? They have taken our South African rand on today's date, bought the 250, but they don't know how much to buy because it's gaining interest in the US. So while it's gaining interest in the US, we need to work backwards how much dollars we require. So this is why the calculation is there. We need to work out backwards, and we require $249,319. Now that is the dollars we require on the date of 10th of June, but we need to buy those dollars at 9 rand 947. So we buy those dollars at 9 rand 947, which gives you 2,479,976 rand. But we borrow the rands from the bank at 8% interest, 8.5% interest compound per annum for 90 days, which then gives us a future value of 2,532,000, which then also is for the rand value is 2,532,000. You divide that by $250,000, gives you an exchange rate of 10 rand 13. There's a 10 rand 13. Okay, quite interesting, agreed? What happens to the exchange rate when you borrow money, because if you think about it, each of his own countries have their own currency, and everybody is buying by a local common currency. It so happen to be the US dollar or the pound or the euro or the yen, depending on what we're buying from. Okay, so interest rate swaps here. You don't have to worry about that one. Interest rate swaps is not part of the exams. The second part, treasury, also not part of it. Forward exchange rate agreement, also not part of it. Yeah, they have a calculation. I wouldn't bother with this. No, that last part is not part of the exams as well. 9.4, which has got to do with the treasury bills. Okay, but look at what they require from you here. Tabu has decided to invest his performance bonus 300,000 in treasury bills. Okay, his offered price is 96 Rand 25. I'm not going to even go into it. It's not going to be part of the exams. Okay, now basically it's similar to the previous one, but now you're borrowing money. What is the effective interest rate that you have to calculate? On the previous one here, we calculated the effective exchange rate, and that will be the effective interest rate. Okay, so that, people, ends this chapter. I wouldn't do this once again. Okay, they're giving you a conclusion. For every answer, there should be a conclusion. There is two questions that you can go through, and that second question brings you down to your textbooks that you need to look into it. Okay. Moving forward, next week will be our last lesson for this syllabus. I'm going to be bringing 2 question papers that I have with me to go through with you guys. It's imperative that you are there, because we're going to be doing exam prep and stuff, and the following week after that you guys are writing, for those who are doing 3702. For those who are not doing 3702, you're doing 3671, I suggest you please, according to the coordinator, I'm not supposed to be tutoring anymore after next week for 3701, because the lessons close then. What I do suggest is send me emails or approach the e-tutor of this syllabus for questions. Okay, but you can send me emails. My email I put up on the chat, so please remember to take it down. I'll put it up again. I hope you guys completed the attendance register. Moving forward, any question from your side? You all okay? I see. You understand where I'm coming from? Do you want me to repeat anything? You all okay in that? Because of the information we have given. Okay? So, as I said, please complete attendance register, and I will see you next week for the final revision class and exam preparation. Thank you very much. Enjoy